Less than a year ago, US inflation was sky high, reaching 9.1% in June of 2022. Fast forward about 8 months, and inflation has continued to fall steadily each month since, currently sitting at 6.5%. This seems like a good thing, right? But at what cost? Along with lowering inflation, interest rates have continued to rise, up to 4.75%, with room to move higher. So what do these scary numbers mean for the rest of the economy, the job market, or the housing market? Fed Chair Jerome Powell spoke on these issues recently during a press conference and gave us a little bit of clarity in these uncertain times. Jennifer Schonberger of Yahoo Finance summed up Powell's speech well by saying, Federal Reserve Chair Jerome Powell said Tuesday the quote, disinflationary process in the U.S. economy has begun, and said the additional rate hikes will likely be necessary to bring inflation back to its 2% target. Speaking in an interview with David Rubenstein at the Economic Club of Washington, D.C., Powell reiterated his comments from last week regarding inflation pressures, saying, quote, the disinflationary process has begun, and has begun in the goods sector, which is about 25% of the economy, end quote. Powell said this process, quote, is going to take a bit of time and is not going to be smooth. We will likely need to do additional rate increases, end quote, Powell said, as the Fed works to bring inflation back to its target. When asked about Friday's stronger than expected December jobs report, Powell said, the strong labor market, quote, shows you why we think disinflation will be a process that takes a significant period of time. The labor market is extraordinarily strong, Powell added, noting it is good inflation that has started to come down with a strong labor market, end quote. Still, Powell's comments did not suggest Friday's strong job report would change the central bank's approach to future rate increases. As Powell spoke, stocks rallied to session highs, though markets later gave up those gains in afternoon trading. Though Powell added the caveat that if we continue to get higher inflation reports or job reports, the Fed may need to raise rates more than what's been priced in by investors. So is this good news or bad news? On one hand, it seems the labor market is doing much better now than it has been as of late, and inflation is on the decline. On the other hand, it seems raising interest rates is still very much the plan moving forward, and Powell mentions it will still take a long time to get inflation down to their goal of 2%. How long will it take? Will it happen this year? Is it even possible in today's age to reach 2% rates and keep them that way? And how will all this continue to impact the housing market that seems to be on the verge of another collapse? We should hopefully get more answers on February 14th, the day CPI numbers will be released. If we come out of the CPI event with good news because inflation has continued to fall, perhaps the Fed will wait longer to raise interest rates again. That way rates don't rise too quickly, or at the very least, maybe we'll get one last raise for a long time and will stay steady before rates are lowered sometime in the future. Simon Moore of Forbes had this to say about the upcoming event. To be clear, recent inflation data has been generally good. Inflation has trended lower. That's due to the easing of energy and food costs, and the prices used for cars and various goods have actually fallen in absolute terms in recent months. The Fed has started to acknowledge these encouraging trends too. However, concerns remain specifically as shelter costs, which carry a large weight in the CPI series, continue to rise steeply. There's a good reason to think that might change, but we haven't seen it in the CPI data yet. Also, the Fed worries about wage growth continuing to push service costs higher, as the recent strong jobs report won't have comforted the Fed on that score. There's a chance coming inflation data is a little less reassuring. Certain energy prices, such as crude oil, are no longer declining. Food and energy have helped bring down headline inflation numbers in recent reports, but the real wildcard is the CPI report in housing. Redfin data shows house prices have been trending down since May of 2022 and are up just 1.4% to December 2022 on an annual basis. That's a lot lower than the price growth we saw for much of 2022. The upcoming CPI reading will be important to the Fed and markets. The generally accepted narrative is that inflation is trending lower. Still, if CPI data shows prices not moderating as fast as the Fed would like, then that could be further justification for another rate hike in May, which markets view as probable at this point. And there's even an outside chance of a June hike from the Fed if inflation remains stubbornly higher for longer. So what does this mean for markets? Is the recent dollar bullishness going to hold up? How will CPI affect the indices? Daniela Hathorn of Capital.com had this to say about the economy and upcoming CPI report. Quote, "The data from December is still painting a much weaker picture of the economy, and I expect that is where traders are putting most of their focus on. That's why the rest of the data for January is going to be key in the next couple of weeks. The CPI on Tuesday will be very closely watched, and I expect volatility to ramp up around the event as markets try and figure out whether the jobs data is the one outlier or if it's an early indication of the fact that there may not be a recession this year as previously thought. At the end of the day, strong economic data should be a positive for equity markets as it reflects future profitability for companies, but markets seem to be stuck in this need the Fed to reverse tightening mentality that makes it hard to try and forecast what the reaction will be for the upcoming data. For now, US equity indices are testing the waters to see how much appetite there is to move higher, which will likely see some consolidation with the bullish move with a bit of sideways action and restricted sell-offs. The daily S&P 500 chart has marked 4 consecutive candlesticks with lower highs and lows despite the attempted rally on Tuesday, which is a sign of weakness within the upward trend. That said, the price has finally managed to catch up to the RSI in achieving a break above the December 13th high, which has cleared some of the bearish pressure, but they are both now trending downwards. All eyes are on the Fed and Tuesday's report.
Make sure you guys check out the links in the description if you need broker recommendations, access to our free Discord, or want to chat with us on Telegram. If you're interested in our trading software, the Edge Finder, you can find that in the description as well. Thanks for watching.